The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville, it's Thursday, January 12th, 2023, a new year. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're really glad you're here with us tonight for a new year and our fourth year of doing these. We started in 2020, so 20, 21, 22, 23, here we are. Tonight, we have a special segment on our investment methodology. Okay, and the reason that we're featuring this is because people have asked me for it. So you guys have seen this matrix, right? And you know that we're going to look at the outlook. You saw that if you guys are on the system and you see my updates, what I'm going to be talking about, 23 outlook, and then our investing strategy. So these are the topics that I cover every single session. These are actually macro topics, and we're going to talk about that in the investment strategy. I've never really drilled down into this, but I got enough requests that I think that it's going to be a good segment tonight at the end. And I hope you don't need aspirin at the end of it because it's technical. But it's some important for me to tell you guys how I manage your money. Those of you that are just listening and enjoying the program for getting investing ideas, that's fine too. But for those that are actually clients, I want you to know what procedures and strategies I use to develop what we do. So that's why we're going to cover the investing methodology in the last segment tonight. If you are new to the program, please subscribe to us on YouTube. Click the little bell so you get updates when I go live. Also follow us on Facebook and Twitter. So I tweet every single day. You can see those tweets on Facebook, LinkedIn, and Twitter. And I would suggest you do that because if something happens in the news, I'm all over it. All right. So let's start with my beliefs as a portfolio manager. The U.S. is in a stronger position to recover in 2023 than the rest of the world. We are in the right place here as Americans. If you're listening from overseas, I'm sorry, but that's the reality. There will be a lot of money coming into the U.S. because our economy, our markets are the strongest in the world, and they're going to be seeking safety and security. We, the United States, will be the leaders who pull the rest of the world out of recession. And speaking of that, I am not expecting a severe recession. I think we're already in one. I know that many people in the corporate news are just milking this to death. Do not watch the corporate news. This is a Bloomberg consensus with T.S. Lombard, which is a really good research firm. Look at 2009. We all remember that, right? Okay, so this is the expectation. The two asterisks mean that's what the FOMC, which is the Federal Open Market Committee, just think it's the Fed, okay? And then the consensus of other economists. Both of them are predicting about the weakest recession. And a weak recession is a good thing, okay? Weak economy is not, weak recession is good. Okay, so no way to sugarcoat this. None. 2022 was absolutely awful for the stock markets. Worst year since 2008. 2009 started out poorly, but then really corrected well to the upside, as did 2020. But 2022, it did not. So the Dow ended down about 8.8%, S&P almost 20, the NASDAQ down 33%. And those of you with CG accounts where we mostly invest in NASDAQ stocks are feeling the pain on that. I get it. I am too, as all of you know that watch this program for any length of time. I invest just like our clients do. We have our family accounts invested in each of our programs, okay? So we're dealing with 4-decade high inflation. The Russia-Ukraine war continues. The COVID pandemic, at least it's raging in Asia and not here domestically. Labor shortages continue. Supply chain issues are worldwide. And this unprecedented Federal Reserve tightening, and by that I mean 75 basis points meeting after meeting after meeting. So 4 or 5, I've lost track here. But at least the last raise was 50% or 50% was 0.50. Okay, so it's 0.50. So we're moving in a moderation there. And that is the bad news for 2022. But there is good news. And here it is. The longer term returns after the worst years ever are pretty good. Since 1928, almost 100 years ago, there have been only 8 times, so 8 back-to-back years with back-to-back lousy market performance. All right, 8. I'll take those odds. All right, I'll take those odds, and I think this bodes well for 2023. They talk about the January effect. We had a pretty good day today in the market, and overall January is up about 3.5%. If we are able to finish this market on January 31st, right where we are even, it's a good January. If we get up to about a 5% return, that's a stellar January, which again bodes well for 2023. You guys have seen this chart. I show it almost every program. This is the 100-year return of the stock market. The red blocks are the secular bear markets. Those of you who've been watching know there's a distinct difference between a secular and a cyclical market. So the red are secular, which means multiple business cycles. All right. We are currently in a cyclical bear market. That's what the yellow is. Lean in if you need to, but that entire downturn, that's what 2022 was. The peak of the year was January 3rd. All right, so we're in a more than 1 year bear market right now because we're at January 12th, right? But you can see the proclivity of what happens over 100 years. Could we stay in this protracted cyclical bear market for a while longer? It is possible. Those are not the internals that I'm seeing. Has this taken longer to recover than I thought? Absolutely. Are there good reasons for that? Yes, you just saw them on the bad news slide, right? The market is doing remarkably well with so much bad news being thrown up against it. I always show this graph, and it's really light for January. It's always light January, April, July, and October because this is the S&P 500 earnings reports, and only 20 companies are reporting so far. Obviously, there are many other companies that are reporting that are not in the S&P 500, but so far we're right about the average. So those of you that watch the program know that 73% above, so look at the green line up there where it says S&P 500, above 75%. That means 3/4 of the companies, only 20, have reported earnings that exceeded what they forecast. So that's a good number. 73 is again the norm. 75. We'll know a lot more when we come back and look at this in February. What we do know is that the 2022 quarter 4 earnings growth rate is declining. So obviously right now we're in the first quarter of 23. So we're looking at earnings from the fourth quarter of 22. And we believe that they're declining. And so we're not going to be too excited if we see a downturn here. That 75% on the previous slide becomes 70, 65. I don't see it going much below that. But again, there are a ton of headwinds, and the market is holding up amazingly well considering those headwinds. Let's look at inflation. So I mentioned earlier on an earlier slide that inflation is not predicted to be a huge problem, and therefore a recession is going to be fairly tame. In fact, the tamest in 50 years based on the slide I showed you earlier. This is the hard data, by the way. You're going to see that this contradicts, especially when we get into the employment data. It contradicts what you're seeing on the news because I'm not trying to gather eyeballs. I'm just giving you double source data. So you'll see in the lower left-hand side, those of you that are new to the program, that I do research. We pull this together. We put this program on for you monthly so that you can see the hard data that is occurring and what's really happening in the economy without all the drama that the corporate media bring to you. So inflation reports have been surprising to the downside. So we want the market to go up, but we want inflation to go down. And you can see here clearly since the beginning of 2022, it has slowly been coming down, and that's a good thing, all right? So what actually goes into the Consumer Price Index? I've never shown this graph. People ask, well, what is the CPI, Consumer Price Index? Roughly 33% is shelter, and that would mean mortgage payments and rent payments. Food, that would mean what you cook at home and what you go out and eat. That's 14%, transportation, energy, etc. So that's how it breaks down. That's what the Commerce Department uses to determine which of these various areas of the economy are increasing in price. That goes into a formula, and it's cranked out every month as the Consumer Price Index. And that number was actually issued today, and it was as expected. All right. So this is the trajectory that we saw in 2022. It ramped up into June, and then it started tapering off. Okay, so the move from 9.1 in June to 7.1 in November is 2 percentage points. That's pretty impressive. But you don't hear that in the media, okay? But this is the actual data. So do we still have high inflation at 7.1? You bet we do. Is it going in the right direction? Absolutely, all right? That's what you need to remember. So the headline and core CPI are both projected to drop. All right, headline and core. So we need to talk about that. What's the difference between headline and core? I'll get to that on the next slide. But I want to show that one of the most volatile areas of the CPI is food prices. The projection is the red line, and what the index is actually looking at here from the economists around the country is the black line, which is that it's going to drop. So that's in sync, going back to this slide, with what you're seeing here. All right, so break-even inflation. All right, this is, I know, getting a little techie here, but just hang with me, guys, okay? Is the difference between the nominal yield on a fixed rate investment and the real yield after inflation. So what concerns us about inflation? Well, a lot of things, but one of them is if we have bonds, if we have CDs, and those are fixed rate and they're at 3%, and the inflation rate is 4%, or in the case of what you just saw, 7%, you're losing money every single month because your fixed rate of return is 3 and the inflation rate is 7. So while your money is sitting there locked at a rate of return, the cost of the items that you're buying every day are rising. So that is a negative break-even inflation point, all right? But we're seeing this declining, all right? So the 3-year break-even, the 2-year break-even, the 1-year break-even, this is the hard data. It's going down. It's going in the right direction. Is it still hotter than we want it? Absolutely. But I think that's why you're seeing the market firm up here in January, because the big players, again, I don't really care what the news media says, as you well know by now. I care what the traders say. In fact, frankly, I care more about what the bond market traders say than the stock markets. The bond market is a bigger market than the stock market, and those traders are really, really, really smart. I'm not a huge bond investor at all, but I do trust their knowledge. So interesting, and this is the last slide in this section. Look at the consumer inflation beliefs. The consumer thinks that inflation is way high and not going to go down because the consumer's not looking at those slides that I just showed you. All right? Don't be in this group because this is affecting people. It's scaring people from being normal, everyday USA consumers. 67% of our economy is driven by the consumer. The rest is driven by business expenditures and government expenditures. That's what makes up GDP. But the consumer is reticent because they're hearing these news reports and they're seeing that, oh my gosh, it's never going to end. But the data that I just showed you, that's what this show's about, folks. That's the real thing. It is coming down. Is it high? It is. 7.1, terrible inflation number. Is it better than 9.1? You bet. Did it rise this month in today's report? It did not. It's continuing to flatten. So the employment scenario, the reason we do this show the second Thursday is because the first Friday of the month is when the monthly employment data comes out. And it used to be the most important data of the month. But right now, the recession and inflation data has become the most important. So the jobs report surprised to the upside. That would sound like a good thing. Look at the spike there, okay? But we're in an environment right now where good news is bad news. So here's how the market works. There's 4 possibilities. 4. Good news equals good news. Bad news equals bad news. Good news equals bad news, and bad news equals good news. So when the market's been beaten down and there's a bad report, okay, the market goes up. You're going, why would that be? Well, because everybody's betting that the Federal Reserve is going to chicken out and start softening their policy, okay? Works every time. And so when you see firm data and the Federal Reserve is concerned about inflation, they're raising rates or talking in a hawkish tone. All right. So still, payrolls, the survey was 200,000. This is in 100,000s here. And the actual number was 263. We are still growing as an economy, guys. We're a rock star country. We just are. All right. Unemployment rate survey was 3.7%, dropped to 3.5. But look at this. The underemployment rate. I don't mention this every time. So unemployment, underemployment, you don't have a job. Underemployment means, well, I've got a job, but I really want more hours. I'm not getting the benefits that I want, but I'm going to stay because I don't have anything else. So the underemployment rate is the lowest since recorded data. That's even better than it was under Donald Trump. I'm sorry for those of you on the far right, but it's just true. Do I think Joseph Biden had anything to do with that? I do not. The market itself is what's driving this. So U6, lifetime low, 6.5%. There's still a labor shortage. 3.5 million people. There are more jobs open there than there are workers to fill them. And yes, I know that there are layoffs. Amazon just laid off 18,000 people. Meta some time ago laid off a ton of people. All right. But overall, there are still jobs out there. So in the political section, the reason we cover this, because politics leads to policy. Policy leads to portfolio impact. Portfolio impact affects your personal life. There's all the P's there for my English teacher in high school. There are a lot of items I could put in here, like discovering classified documents in Biden's home and his hotel and his boat and wherever else after he just ordered the raid on Donald Trump a few months ago. But I digress because those don't affect the market. We read them and we either get mad or gleeful, but it doesn't affect the market. So there are only 2 items this time that affect the market, in my opinion. So the ongoing war between Russia and Ukraine and the coronavirus pandemic in China. So the rest of the world has pretty much tamed it. Certainly here in the U.S. we have, although I just had a family member come down with it far from here, but in New York. And we're concerned and praying for them. But for the most part, it's an epidemic now, or a pandemic, I should say, in China. So the U.S. and its allies are preparing their next round of sanctions. They're going to try to cap sales prices of Russian exports. And the reason this has a financial impact is because if crude goes higher and we start seeing prices at the pump in the $4.5, well, that's probably right there right now, $5 to $5.50 range, obviously that affects consumer discretionary spending. And what percentage? You guys were listening. 67% of the U.S. economy is driven by consumers. If they're having to fill up their tank with more expensive gas because of what's going on between these 2 countries, that's not good. And that's one of our fundamental data points when we analyze for the market, which I'll talk about in the last section. So the other thing is the big red splot here, and that's COVID. So many of the conspiracy theory folks say that the Chinese cooked up this thing and it began in Wuhan, which is actually there on the map. But now they are really in a mess over there in China. And why does this possibly affect us? Because there's a lot of American manufacturing right now that's being done in China. And if the Chinese are known to be erratic, maybe, could go in and shut down an entire city. And if that happens to be where there's an Apple plant and we can't get iPhone 15s for 120 days delayed, that affects our economy. I'm not trying to be heartless here and saying I know there's a human component, but this is a financial show. That's why I'm watching these 2 macro events on the political front. So what other economic indicators? Again, this is all the macro stuff that I use to assemble to make decisions on your portfolios. The GDP of the top 5 nations, we just talked about GDP. It's the total of all goods and services produced domestically in a country. 67% U.S., different in other countries, but 67% is the consumer driven. So the U.S. is 24% of the entire world. One almost out of every $4 produced in the world comes from the U.S. If you add together China, Japan, Germany, and India, it's 26%. The next four countries, just take that in for a minute. So when you're hearing about how China is going to take over and they're going to get rid of the dollar and they want to wipe everybody out in this country, that may be true. But in an economic sense, not even a chance. Not Japan, not Germany. And we rebuilt those countries after World War II, and they're coming along just fine, thank you, but not compared to us. This is why I continue to favor the U.S. for investing, and why I said earlier in the program, the U.S. is going to be the country that pulls this world out of a recession, which I believe, as do many other Bloomberg economists, but this is going to be a shallow recession. Okay? So consumer credit now above the pre-COVID trend, so people are spending their money. All right? They're doing it. And unfortunately, they're not getting the raises that they were first getting when COVID stepped in, okay, in 2020, that was February of 2020. It used to be that there was a hiring frenzy, and we covered that on the program this time last year. All right, that frenzy is not out there. We're still positive. I showed you the employment data, so we know that that's strong. All right, but credit card debt as a share of disposable personal income is back to rising. That's not necessarily a great thing. And because of that, household excess savings are dropping. Now, I can't trade off this data. All right. And I've present this data to you so you can know what's going on in my mindset. And then I'm going to drill into at the end of this program for the first time in the 4 years we've been doing this as to how I use this data to make decisions on your behalf. So household excess savings likely to be gone by mid-2023. I'm not sure of that, but that's what I'm seeing out there, in that people are in do what I do, economists, whatever, and saying, based on our calculations, there aren't going to be any savings, and it's going to be a deficit lifestyle to continue the same lifestyle. People are loath to give up a certain lifestyle. So if they can't do it from income and they can't pull on their savings, they're probably going to put it on their credit cards. And of course, that puts, I shouldn't say unneeded risk, but it certainly puts risk on the consumer that they don't have when they're spending from regular cash flow. All right. Look at what it's done to the United States with $16 trillion in debt. All right. So what role does the Fed play in all this? Oh, gosh, where do I start? The Fed, and I said this in the December show, underwent the most radical raising of interest rates in history. And they did this because they were playing catch up, because they did not properly forecast. What they kept saying was, this is just transitory inflation. Well, you can say that for 2 or 3 months, but if you say it for 1.5 to 2 years, it's a problem. So this very big spike here, which you're seeing in interest rates, and you can see how it was laddered back in 2003, 2004, 2017 to 2020. It's not laddered. It's just straight up. All right. But we are expecting this 50 or to 25 to 50 range to continue, even though Powell was pretty hawkish. Now, what happens is when financial conditions continue to increase, and you're seeing positive data right here in this program, the Fed actually does not want to see that. Look at the top line. Easing financial conditions is not what the Fed wants to see. The Fed wants you to stop spending. The Fed wants the sun to never come out. The Fed wants you to be depressed. And you can see I'm saying this with tongue in cheek. But the reality is they don't want you to be exuberant American spenders, because that's what drives prices higher. And that means they have to continue to ratchet up interest rates. And they don't want to do that because Jay Powell wants to be able to go home at night and have safety in his car. And, it's just, they mishandled it, folks. They just did. The market predicts where Fed funds rates are going to go. Of course, there's a market for that. And it's a pretty deep market. All right. This is what the market is saying. All right. In the overnight rate, which is similar to the Fed funds rate, there are multiple short-term rates in the fixed income world. And the market's saying, no, we can see inflation's coming down. It's going to drop. So These are the people that I pay attention to, even more than Jay Powell, because they're usually betting hundreds and hundreds of millions of dollars, big firms, on these bets that something is going to happen, a macro event. Inflation's going up, inflation's going down, the debt is going up, the 10-year yield is going up, it's going down. All right, they're smart people. Policy expectations for the Fed funds futures. Again, these are the futures traders that trade the Fed funds rate, basically front running what Jay Powell and his cronies say. I think it's 8 times a year, in their meetings. So those are projected down as well. I am encouraged by that. If I saw that going up with everything going on, I would be concerned. But again, we're having a pretty good January here. And as goes January, for the most part, how it goes the rest of the year. I'll have a little more information on that in February once we've gotten this behind. But there is history on how much January really sets the tone for the year. So now the odds of a 25 basis point hike at the next Fed meeting are more than 93%. Again, these are the traders. This isn't Jay Powell saying, probably about a 9 out of 10 chance we're going to do 25 basis points, because I wouldn't believe him anyway. What do the traders say? The people actually putting money on the line, not sitting there scratching their heads in a meeting and going, how do we blow this? All right. That means to me, and they could be wrong. Traders are sometimes wrong, and then the markets lurch around and they get adjusted. But they're saying no, we're headed down, and that's a good thing. So the housing market, just have one slide for you. If you're trying to sell a house right now, not the greatest time. Look at this plummet, and it's affecting different price houses. I didn't break this down into $100,000 marks or anything, but lower price homes are not getting hit as badly as high priced homes. Look at the blue line just dumping there from 18% premium down to a 4.25% premium from Jan 13 to January of this month. So not a great time to be selling, and yet there are still buyers out there. And why? Okay, they're out there because they're looking for bargains. And if you're going to be selling in one market or one location and buying in another, you should be able to benefit from pressure on the buy side, even though there's pressure on the sell side. So I get asked this from time to time. I've never put the slide up here, but now I have. Is real estate or the stock market a better performance, a better market, or better investment? Well, for the majority of U.S. history, at least as far back as reliable information goes, and that would be about the 1950s, housing prices have increased only slightly more than the level of inflation in the economy. All right. There was an exception from 1990 to 2006, and there has been an exception from 2020 to roughly halfway through 2022. The stock market has consistently produced more booms and busts, but it's also had better overall returns. So that is why I still continue to recommend not paying cash for homes. If you have it, put down whatever you need to put down to avoid private mortgage insurance, to get a better rate. But any other money should be put in something that has a better chance of appreciating. Overall, didn't want to put this on the screen because I can't corroborate this yet, but I know the S&P on an annual basis from 1950s around 9 to 9.25. NASDAQ over 10%. I didn't see any data that showed real estate any higher than the rate of inflation, or 3.5 to 4, maybe 5%. That's a 2.5 times difference. So own your home. I think that's a great idea, but not the place to invest a ton of money in your personal residence. So, all right, I've been promising the CB3 investment methodology. So this is where I'm going to take a brief break here. You got about 20 seconds to type in questions. That's what the delay is on YouTube. I'll handle those and try to address as much as I can as we talk about how we make decisions on your accounts. Did I say hi to everybody? Hey, Charles, how are you? In Orlando. Hey, Greg. Oh, you're both there in Sugar Grove. Hey, Greg and Martha. Good to see you guys. Happy New Year. All right. I think we've got 3 time zones. That's good. Fantastic. All right, guys. So how do we make decisions? Pretty important thing to know. I haven't done this before. I've done it in my live shows. I stopped doing those during COVID. May do those again sometime, but it's been a couple years. So I thought I should put this down so you can come back to it. I'm not going to belabor each of these points. But you can come back and play it back and take notes. And then if you want to ask me questions that you don't want to ask in the public forum here, just contact me, cb3@cb3.com. All right, so how do we make decisions? Well, a top-down, there are only two ways to do this, really. I mean, you can argue there are more, but there are really only two. Top-down investing is interested in looking at the big economic factor to make investment decisions, and we drill down to the individual stock. That's the last decision, okay? Because you can't invest a macroeconomic indicator. You can only invest a stock or an ETF or something that's investable, traded on an exchange. All right, a bottom-up investing is what more fundamental analysis firms do, the Goldman Sachs's of the world, et cetera. They look at company-specific fundamentals first. So they're looking at their financials, the supply and demand, the kinds of goods and services. A lot of CFAs, chartered financial analysts in that kind of work. But that's not what we do. It's about 50-50 in the industry. We are definitely a top-down investment firm. So where do we start? Well, you've seen this, and it's exactly what I use. So the matrix on this, I have a monthly market review of every single stock, every sector, every country, what it's doing, what their GDP is. I look at all those economic indicators. So drop down here on the matrix and you see me talk about economic indicators. I look at a lot more than I show you here because I started getting complaints that the show was running 1 hour and 10 minutes long. Just know that I do look at them. I'm looking at the world economy. Where am I seeing strength? I just showed you that slide. That's all you need to see. The US is 24%. The next company at China is 12%. Okay. Yeah. And then all the rest of them added together, we are still the dog that is wagging the tail. Employment scenario, obviously, whether people are working or whether they're not working, really, really important. That changes month to month. Data comes out the first Friday. I bring you my show on the second Thursday. Inflation, is it tame? Excuse me. The longest window that I've ever seen, at least since I've been doing this for 32 years now, is basically the last 5 years before we started to have this spike in inflation, where the Fed funds rate didn't move. It was a variable rate 0 at 0.25%. All right, but once that started moving up, once CPI started moving up and the Fed started tightening, as you've already heard from me, they were late. Inflation definitely affects mindset, it affects cost, it affects everything in the economy, which could lead to, the next screen there, recession. So these are, again, macro events. I have to look at U.S. policy. As I said tonight, the war in Ukraine and the COVID situation in China, which could shut down manufacturing for U.S. plants. And I know I always have to say this, there's a human component too, but in a financial show, how does U.S. policy affect what could affect in the future the stock market? Economic indicators, sometimes I have more. I had a few less tonight because I know this section is going to be longer. But there are a variety of economic indicators that are everything from the number of used car sales. And if you've been watching us since we started here in February of 2020, then you would know that we have sometimes 10 or 15 economic indicators that I think are really, really important. When the year starts out, not so many. Okay, but what really is important this time of year is the Fed, because they're trying to set a tone for what their posturing is going to be for the rest of the year. And obviously that can change, but it's important that we get a drift of the Fed. I mean, one of the commentators said, you know what? Greenspan used to show up with a tuna sandwich when he was maybe not wanting to have anything too heavy. When he was confident about things were going, he'd have a sirloin steak for lunch before the Fed meeting. I don't make this stuff up. I just heard this on Bloomberg this week, okay? So you look into every little piece of data, which is datum, so a singular data point is datum, and you put together a viewpoint, okay, what do I think is the health of the world economy? Should I be investing and where? U.S. housing market. So housing market is the most important consumer discretionary item. Why is consumer discretionary important? I've been saying 67%. All right, of all of our GDP is driven by the consumer. What's the biggest item that the consumer buys? A house. Second is cars, but not even close to what they spend on houses. So we need to follow the housing market. We summarize all these data points, and that brings us to sector selection and ultimately to stock selection. All right. Feel free to type in the chat box if you have questions. Okay. And I know there's going to be a ton of data here, so you may just have to email me later, but that's fine. But I will handle live questions tonight. So those of you that have been following me for some time, and again, you're not going to be able to see all the letters on here. It doesn't matter. You know that this is an RRG, a relative rotation graph. This shows the sectors in the U.S. market. All right, the center point right there is the S&P 500. And there are 11 sectors. You can see their little labels there. If you're a sector in the green quadrant, that means you're outperforming the S&P. Okay? If you're in the yellow quadrant, that means you're still outperforming the S&P, but you're weakening. If you're in the red quadrant, that means we don't want something in there because it's lagging. And then the blue quadrant is improving, but still underperforming the S&P. What matrix do I use for buying and selling decisions? Moving averages. That's coming up, Charles. Great question. Watch for it. All right, about 3 minutes. So I'm looking at where the sectors are that are performing. These are weekly data points. Sometimes I'll go to daily, and sometimes I'll even go to monthly. But I just want to see all the sectors, see where the opportunities are, see what I need to avoid. Believe it or not, just knowing what to avoid is half the battle. Even if you pick a sector like XLU, which is blue, which is improving but not quite going into green, if you avoid having too much weight in XLY, which is consumer discretionary, consumer's a little freaked out right now. Remember the chart I showed you. The chart I showed you said, look at how inflation is looking. Look at how it's looking. Great data, great data. What's the last slide in that section? Showing that consumer concern is very high. And they're reflecting it by not buying as much as they normally do. And that's why that red line is on the chart. That represents the consumer discretionary sector. And that is how I put this together with these sectors and make a decision on what sectors I want to be involved in. The second part of sector analysis, again, you're not going to be able to see these numbers, but see that there are 12 bars. All right, every bar represents a month. This particular seasonality. So this means certain sectors do better in certain months, certain times of the year. You might think that heating oil, for instance, does better in the winter. That's kind of obvious. You might think that housing does better in April and not in the winter, okay? And take that across 162, I think, industry groups, of the 11 sectors. And we're looking at that to see where opportunities might exist. So right now, this is actually software. And 91% of the time, if you can see the itty bitty 91 in January, software outperforms the S&P 500. So if I am going through my technical parameters, which Todd just mentioned here, so what are your buying and selling decisions? If I see that it's a software stock, I know going in that I like where that particular stock is on a seasonal basis, okay? So the question might be, before I move on, as far as these sectors go, why don't I just buy the sectors? Well, that's a good question, and here's the answer. So this is XLK. Remember, there are 11 sectors. This is the technology sector. Of the top 10 holdings, Apple at 22%, we're going to call it, Microsoft 21%, NVIDIA, Visa, etc. All right, those are the top 10 holdings, and we're at over 50%. All right, if I want Apple but I don't want Microsoft, what am I going to do? This is the reason I don't use ETFs very often. For our smallest account programs, if you only have a relatively small account and you're not in one of our managed programs, we have a lot of kids accounts that are doing this, that they're saving up for college, All right. We don't invest in ETFs for this reason. What we will do, though, is look into the ETFs and see where we should be investing. What are the winners? If we've picked a sector that we like, or 2 or 3 sectors we like, how do we get to the stocks? And this is answering your question, Charles. So we have a process called screening. There are thousands of stocks across the globe. And to look at the balance sheet and income statement of all of these stocks is impossible. I suppose if you're Goldman Sachs or Citibank, then maybe you can do that. I don't think it's necessary because the market tells you what is performing well, and that's why I'm a technician. The CMT that's after my name right here on the screen stands for Chartered Market Technician. There are about, last time I checked, 8,500 of us in the world. Right? It's a pretty rigorous testing thing. I don't know if it's equivalent of a master's degree, but it's a lot. Lost sleepless nights myself when I was doing that. So we screen. If you look in this column, you'll see we have screens for CG, for GI. We screen in Tokyo, London, Europe, volume leaders. Again, if you stop the recording at some point, you want to look in and see the various scans. These are all various scans. This is called screening. And basically what I do is determine what technical parameters are important to me. Again, I've discovered what I want to do by looking at the large macro, top down, right? We're not a bottom up investor, we're top down. But at the very end of that, we have to make a decision, because you can't just say, I'm just going to trade housing starts. Doesn't work, right? You have to have a stock that relates to that. So we're screening by sector and by different countries. So CG and GI, our primary two programs, only trade American stocks, but I will be expanding on that relatively soon. So our third program, Speculative Opportunities, known as Spec Op, trades in Tokyo, in New York, in Europe, and in London. So now, again, you can't see all these parameters, but what I can tell you is when I click sort and screen or go, whatever you want to say, the screening itself produces a list of stocks that meet my investment criteria. Now I have, and you can't see this, but if you see that little blue blob at the top there are 13 filters involved. These are moving averages. These are relative strength. There's Donchian channel. Again, just technical stuff I can explain. You guys have a question on this, I'll do it. And it's going to produce, and I want the smallest amount of stocks. I don't want one or two, but I don't want 100. Okay, so if I get too many results on my screen, I make it harder. So think of it as like training for the Olympics. It's like, okay, but I'm going to say you can't just have, be 3% above the 20-day moving average. You got to be 5%. And I just keep eliminating, because if I need to find 3 or 4 stocks, I don't want to choose from 25. I want to choose from 7. And so I have these parameters, and you see the blue. So that's why I say on here, a stock must be all blue in the first 6 columns. Again, if you want to know what those columns are, I'll send it to you. Once I've done that, then I'm going to drill down and decide which of these really looks attractive and make a timing decision. So this is Air Test Systems. Okay, this is a nice play we had just recently. Look at the 52-week range. So in the middle of this chart over here, you'll see 52 WK range. So you can look at that and see that the red bar is over there at $29.99. That means that it hit a lifetime high today because the day's range is at $29.99. So that's interesting to me, because that means the stock is strong and it's pulled back just a little bit intraday. So if I've been looking for a technology stock, this is electric technology, production equipment, basically, and I want something that's hit a new high, I want something that's got strong volume. So look at the average volume, 2.4 million. That's plenty of shares for the size that we're trading for all of our clients, because we trade as a block. We don't go into every single account. I hit one buy on AEHR, and it puts the stock into everybody's account proportionately to the size of their investment. Okay? So what we're looking for is this. I mean, this is a 41% winner in this stock, and then immediately shave some profits off of it. This is the goal. So your mileage may vary. If you're in GI this week, you had this performance in your account. There are many times when this does not happen. And therein lies the secret to investing. You ready? This is really all you need to know. I can show you all this cool stuff about how I screen stocks. Here's the truth. You can almost throw a dart at the wall, and if you have sector analysis, and so in other words, you're in the right sectors, it doesn't necessarily matter every single time which stock you're in. And I wish it weren't so. But the math shows that. And what you have to have is risk control. We risk no more than 1% of portfolio risk on every stock. So $100,000 portfolio, and I buy AEHR. Doesn't matter what price we pay for that. But if the cost to buy that stock was $10,000, which should be high on a $100,000 account. Let's say it's $2,000. We're not going to risk more than $200 before we cut it off, because we want to see moves like this that are on the screen, and we're going to get moves like that. But we're not going to get that if we have 4.5%, 5% losses of equity in our account and the account draws down 50%. Is it possible to have a 50% drawdown in the market? It is. It's very, very rare. And certainly it's something that we want to avoid. And the way we do that is with very stringent risk parameters, okay? So, again, this gets real techy, but just hang with me. I promise you it's important. So, how do we know before we press that button that this stock has in the past, if we're looking at it right now and seeing, I like this, I like this, I like this, I like this, how has it performed? How has it historically performed? So we take a sample size of this, and this is just like Nielsen, okay? Basically, let's just call it population versus sample size. So if there are 1,000 entities, the sample size is 150, that means it's 150% or 15%, which is low. Okay, the higher the sample rate, the more likely it's going to represent the population and thus provide helpful information. So a sample size of 100 on a population, and this is the 1,000 in this case, would be the number of trades on a particular stock. A sample size of 895 would be really indicative. So if a certain behavior happens in a stock 8 out of 9 times or 8 out of 10 times, we like that. We're jumping all over that. So in general, the higher the sample size will represent that and be more useful, okay? Real important to understand. So I know it's small here, but you see the spike here. This is a different program. So on the right-hand side, and again, you can't see this, these are different historical events where AEHR performed a certain way. Not all of them were profitable, but at this particular moment in time, out of 10, the score was 8. So I knew that we were stacked pretty hard there. I knew the sector was right, okay? And I knew that the timing, based on the previous screen that I showed you, we were at lifetime highs, but we had a pullback, that this is a time. And I don't mean in the next 2 to 3 days. I mean in the next 2 to 3 hours. We need to jump on it, all right? Don't always get it right, but when we see something, we don't sit around and wait for it. We don't put limit orders in. We buy it at the market, okay? So this is artificial intelligence. This is another of the many tools that we use, and this is showing you historically what these various stocks have done. This last one, for instance, is a home builder stock. You can see the little green lines over there on the side. So if certain conditions are in place, this is how this home builder stock performed. Sometimes it blows up, okay? This is AIG, all right? And it was projected to go higher, and then just wham, right down there. But again, risk management is key. You don't just buy a stock and hold it and say, well, it's going to turn around, it's going to turn around. I did that for probably the first 15, maybe 20 years of my career. All right. And pretty much most stocks do come back. But there's a lot of pain that's experienced in that lifetime of waiting for that. So when I say lifetime, you could wait 5 to 6 years, like maybe longer, maybe never it comes back. So we have very strict risk management, percentage of account losses in both CG. It's 1% in CG and GI, and 0.5% in Spec Op. Okay. All right. Okay. Thanks, Debbie. Good to see you. Okay. I think that's it. But guys, that's the methodology in a pretty quick summary. I do this on a weekly basis. The big overviews are monthly market reviews. You can see it on the screen, looking at the world economy all the time, but a serious weekly summary every week. Employment scenario, of course, is every Thursday, which is the weekly unemployment number, but the big unemployment number is the monthly number, first Friday, which I've already told you. Tracking inflation, tracking recession. You can't really track a recession other than you can track the prognosticators of a recession. And I do not turn on the TV. People come into my office, it's like, you got 2 TVs on, but there's no audio. It's like, oh gosh, I don't want to hear them. No. Why do you have them on? I like the graphics. Makes me feel good to see all those little squiggly lines moving around. Really? Yeah, really. I look at some of the data on the screen, but if I'm not listening to them, I can pick the data that I want. All right. policy, economic, etc., and all that leads to stock selection and sector selection, and that's where it goes. So I will pause here for a minute. Our next show is Thursday, February 9th, and I think we'll have more of an idea what earnings are going to look like. I told you that earlier. So before I go to the last slide, any questions from you guys? Don't be quiet. This is your opportunity to ask. All right. So hope that answered it, Charles. What matrix? So that was my screening process. And again, there are moving averages in there. 20, 50s, 200 are my favorite, mostly 20s and 50s. I do occasionally look at parabolics. I look at Donchian channels. I look at Bollinger Bands, look at Keltner channels. Beyond the scope of this presentation tonight to go into that, but it is a pretty structured methodology. I would say that I haven't changed it much in the past 6 months. I adapt, but the same set of tools that I finally settled on, and I guess that's about 14 tools, are what I continue to use to this day. And we'll see. I'm ready to change them if I need to, but it's working pretty well. And we were ahead of the S&P 500 last year in GI, which means we lost less. And we were about equal with the NASDAQ in CG, and we're definitely determined to whoop butt this year against the S&P and the NASDAQ. I mean, that's just what we're here to do. That's what you guys look for us to do. Questions? Deep technical dive. Thank you, Keith. I appreciate that. So, since day one, I have ended with this. In summary for tonight, for we have not been given a spirit of fear. Somebody please tell the news that. But a spirit of power, love, and a sound mind. All right? There's a reason for that, and that's because with proper preparation, we can understand what we need to do to be investors in this market, to invest prudently, to make sound decisions, admit when we're wrong, cut our losses. I have way more losers than winners. And if you think that sounds bad, go back and check the stats on Michael Jordan. He only made about 52% of his baskets. Only? It's a staggering percentage. It's just really hard. Baseball players are, average if they hit 1 out of 4 times. They're stellar if they hit 1 out of 3. 333, hardly anybody bats that now. So what we're doing is making sure that we stay in the game. We don't lose client money any more than is predetermined. Now, obviously, there could be a huge economic event that happens overnight and the markets blast through our stops. And if you want to know what blast through our stops means, I'll be glad to explain it to you in the next show. But I would encourage you to tell your friends this year, if they want to understand how the markets work, what we're looking for as an investment manager. If you're a client, clearly call us anytime. You want to look at your accounts, you want to understand what happened, what may happen, schedule your reviews. If you're not a client and you're just interested in what I'm saying, that's great. Tell your friends, okay? Really appreciate you guys being here. I hope 2023 is your best ever. You saw in the 4th slide, I think it was, that only 8 times in the last almost 100 years have we had back-to-back down years, and I don't think this is going to be one of them. I think we're going to pull out of this, and we will be there with you side by side. God bless you guys. At CB3 Financial Group, we don't just manage your assets, we become one of them. I'll see you next month.